Wish it didn't say that. It's so creepy. All right. So anyway, let's get very quick.
Hold on. Undo that edit.
Ooh. Yeah.
Okay, and just fill in the number of units for each of the types, and it'll automatically sum it up.
Okay. So let's say, oh, I guess this one doesn't.
So 0, okay, and then enter the current rents for each and the target rent.
Okay. Okay. Would you even bother filling these numbers out on the 3-bedroom if there's no 3 bedrooms?
No, because there's 0 unit, so it's not going to factor into the calculations.
Got it. Okay. So we have our current and we have our target. Okay.
Okay. And go over there, yep, and that, and enter the asking price.
Okay.
Okay, and then it should just automatically fill out a bunch of other stuff.
Got it.
Okay, so by default, it assumes 10% economic vacancies and a 50% expense ratio. So do you know any differently from actuals?
Just for the sake of this, let's say they're a little lower on their expense ratio. They're saying that this thing is only like a 30% expense ratio, just for the sake of doing this quickly. So
my rule, so the blue text are things that you're allowed to edit. So for my rule, if they say 30%, that's probably not true. They're probably not counting replacement reserves and maybe some other things. So you can put 30% there. I might put 35 to 40, even under actuals.
Oh, even under even if, I guess my question is, let's say we're going off of quote unquote what they provide. Are you punching in the numbers exactly, or are you still going a little fat on some of them?
I will punch them in exactly, mostly for the purposes of if I'm past kind of the first pass evaluation, I'm digging deeper, I will enter the actuals in line by line. A lot of times that will make it very clear what they're not including in their 30% expense ratio. It's like, oh, they didn't include insurance, right? I mean, mistakes happen. They didn't include replacement reserves, which happens all the time.
Right.
So it makes the omissions more obvious,
right?
When you're line by line. But for now, if you want to leave it as is. So currently, you think their NOI, or you've seen that their NOI is right around 83,000.
Let's see. Yeah.
Okay.
Okay.
So scroll down to the bottom of the marketing package column, and you see the cap rates. So what do you think a normal cap rate is for this type of asset?
So here was the other question, I guess, with that. Is that pre-value added or post-value added, or just run-of-the-mill area?
In that area, so actuals, right? So in that area for the condition of the property as it is now, earning 83K in NOI per year, what do you think the cap rate is for that type of asset? Sounds like it's a well-maintained,
probably
not brand new.
Probably an 8 or 8.5, 8.5.
Okay. So go in and all those blue cap rates, take it from 7.5 to like 9. Okay.
And that adjusted these.
Right.
Got it. Okay.
So now you start to get in the neighborhood of the asking price. Okay. So again, actuals are useful, but what's really important is what we think it can do. So go into your offer column, and this is where your assumptions as an operator come into play.
And so where these target numbers come in as well.
For the future market rents. So the offer is kind of once I've stabilized this thing to my management capabilities and what I think the market rent is, this is what the numbers will look like on a yearly basis. Once we get those in place, then we'll go in deeper and look at current, future, and the details of how we think it's going to get there, which are those first few years, which can certainly swing your returns a lot. So do you, looking through that offer column as far as down payment, vacancies,
Mhm.
operating expenses, you want to enter your defaults
So let's
there?
say there's a little bit of wiggle room and it's 820. Okay. Um, and then is there a reason? I guess I would just adjust this too.
Yeah, I just leave the asking price as the asking price, and then
Uh,
I'll manipulate the purchase number to be the thing that I think I'm going to offer.
Gotcha. So you leave that as the list and then what your purchase price is going to be.
Yep.
Okay. Down payment, let's still say 20. Repairs and reserves.
Um, but I think we talked about this last time, but just to confirm, how much work is going to be needed to get to your market rent?
So let's say that would mean like conservatively every unit would need to be turned for 2000. So is that an okay way to come up with this 40,000 here?
Yep.
Or would you go a little bit more for like general building maintenance or?
I would do so. I would have a per unit interior cost. So if you think it's around 2,000, that's 40,000, and then I would typically do probably a 10K general exterior, larger systems, things that are not purely interior related, and then I would certainly refine that as they go through the due diligence process.
So
But
50.
as a starting point, yeah.
Mhm. Okay. Gotcha. So, all right. That's all good there. Um, this reflects. Okay, so this is from the new.
Yep.
That is the only thing that sometimes throws me on this is because when I've always thought of it that anything blue is a manual input. So I was like, should I be manual inputting here? But it's a blue number, but still pulling from somewhere else. Is that in your world of Excel and sheets still normal?
So that might be a reflection of like I've made some tweaks to this sheet so that it does pull from other areas. It's like I already have this information over here. Why wouldn't it just update it automatically? So blue means you can override it, doesn't mean you have to override it.
Oh, I see. Okay, got it. I thought it was half. Okay, perfect. Okay, so he had vacancy as 10 as regular and no concessions or bad debt. I guess okay, I do have a specific question here. Is this vacancy number um that just for general terms at all times running the building, or is this specific for at any point when you may have higher turnover during a rehab?
For the purpose of this column, again, this is our future stabilized state. So once you have it running the way you want, what do you think you're going to be at?
Got it. Okay, so would you say these are fair numbers to keep in once it's stabilized?
Yeah, I think 10% total is perfectly fair, slightly on the conservative side, but not overly so.
Got it. Okay, so good to move down here, move through.
Yep.
Okay, and then same thing. I guess when this building is running perfectly, conservatively, would you move this down to lower 40s or high 30s or keep it 50 for this model?
Uh, I don't know much about this building and everything, but if it's in a decent area, you think the tenants are going to be relatively low hassle. If you have a good property manager, what they think a building, this type of building can run at. I probably wouldn't go any lower than low 40s unless I've heard very specifically otherwise. So that would be you know, I would say 43 to 44 for a small multifamily like this.
Okay, we'll go 43. Okay,
All
so
right.
good on that. Moving through. He might, let's say this is going to be 5.5, or even he said 6, but maybe it could be 5.5. Would you still go conservatively? 6?
I would start with 6. Yeah, start with the conservative and adjust as needed.
Okay, got it.
30-year AM. Okay. So you see those numbers right below the interest rate and the AM. It talks about, well, below the cap rate, it says cash on cash return and debt and the debt coverage ratio there. So you have
Oh,
13% cash on cash in the offer column,
uh-huh.
and 1.7 DCR. Like those are good numbers, but that's not the average return. That's not like the returns or anything like that. That is once you're up to your stabilized point, it should be running about this. So it's like, okay, well, at least you know once you get it to where you think you can get it, it'll be generating good cash flow and have good DCR. So that's a good first sign, but the devil's in the details. So what I will do next is go to the P&L. So now that we have our basics entered, if you go to the P&L, all the values from your offer column are populated in here and shows you the running of the property, the annual P&L of this property. So my default template has some tweaks. If you'll notice, the average monthly rent in year one is exactly what it is today. So I am not assuming, and these were tweaked COVID style, right? So I'm assuming 2020 is mostly a lost year, no matter what my business plan is, no matter what the market conditions are. So we're going to see no rent growth. I'm not going in there and going to be pushing very hard on it. That's my assumption. If I'm able to do that, great. But my assumption is it's going to be as it's operating now. And I've kind of got a lost year. And then I start moving up. And so year two, I'll take the difference between current rents and what I think you can get to and take the midpoint. And that's what 600 average monthly rent is. And that's your midpoint. And then by year three, I'm like, all right, that's enough time, get past the COVID thing, do some turns, rehabs, and that's enough time to be fully stabilized. My fully stabilized assumption is year three, which is why you see the average monthly rent hitting it at that point.
Got it.
Yep.
That makes sense. And this setup here is something you did manually for these times. Does, like, on blanks standard as is, would this be like dependent on anything, or this would still be manual for each deal?
I think by default, the annual rent and expense escalators are like 3%. So, those are 2016 defaults, too aggressive for me. And certainly depending on the area too. If you're in Middletown and it's not growing, and maybe historically rents have kind of not been bumping up that high, you may want to adjust those assumptions. But yeah, in the default, I think year one, it assumes you're getting to your market rent. And then from then on, it's like 3% escalation in rent every year. And so I've dialed both of those back to be a little more realistic based on what I've seen.
Okay, got it. So we have, just to review or high level summarize, we have our marketing package. Okay. We have our just numbers punched in. We have our, let's say, stabilized property numbers. Okay. And what each shows is a projected summary of returns, right? And then here it also shows projected summary based on cap rate. Okay. And then within that, looking at the P&L, the actual year by year detail is what explains how and when you'll start making the profits that you project and what business model you're using as far as how quickly you're able to turn these units or give yourself enough time to get up to a stabilized property.
Yeah, that's right. And vacancies and average rents and all these things are very dependent or very time sensitive. So so you want to be able to go year by year and tweak these things and really zero in on what you think your reality is going to be, and not be too optimistic that you can hit the rents you want in year one, right? So this is really where you need to go in and really dial your business plan is here. And then the numbers that are generated here get piped into what your total return looks like. But you, in my experience, you really need to get down to the annual P&L level and refine that before those returns are accurate enough to be something that you want to base a decision.
Right. So let's say in this scenario, okay, we're in COVID times. We're going to address this thing as is and know that some of the rents can't be raised quickly and units can't be turned that quickly. We understand that. So I guess just from an actual, like, I'm trying to think what sheet it was in. No. But I guess just looking at it from then the standpoint of like tracking how much you're making year by year during this transition, that would still be in P&L, just further down here, I guess. as far as your property value and your monthly or yearly returns?
Yes. So your cash flow, your NOI per year, your cash flow for distributions, what your debt coverage looks like, that's all in here. One other thing to call out in this spreadsheet that is somewhat unique, you see your year one vacancy and concessions. See how high those are?
Yeah.
That's because for COVID year, right here we are in 2020, I went through and I said what I took from the summary tab, what I thought my stabilized vacancies would be, and I bumped them up like a COVID factor. Um, that's really, really aggressive slash conservative, 11% and 8%. And you can tell it really kills your year one numbers. If you look at your cash flow for year one, it's negative $913. It's
Mhm.
because I'm assuming there's like 20% total vacancies. So
Right.
I that's even too conservative for me. So, and I think now that we're 3 months into COVID, I think we can see that physical vacancies are not really being hurt, right? So if you think stabilized 8% physical vacancy is fine, then I would probably change that number to 8%. And then we're seeing concessions, bad debt, things like that is increased, but not a whole lot. So I might double it instead of, looks like I went 4x here. So if you change that year one vacancy to 8 and your year one concessions to 4%, that's probably more realistic and it'll really change what year one looks like.
And where is this the cell you would make that change?
Yes.
See, okay, I wouldn't have known to do that just because it's not blue. So would you change the multiple here, or do you just override it with 8%?
I would edit the formula so it's just the summary tab without the multiple.
So it would literally just be that.
Yep.
Got it. Okay, I see. So
Yeah, instead
now,
of times 4 there, I would just maybe double it, and that would be plenty conservative.
gotcha. Because now I see what you mean. Instead of right, the other one is pulling as 10% total, 8 and 2. This is 8 and 8, so it's literally doubled. And before it was 20.
Right. So your concessions one, instead of you enter that formula to double instead of times 4.
Oh, I see. Times
That's what
two,
I was saying. Is that
times two, or nothing.
yeah, 2.
Oh, I see. Got it. So
So
these,
and I think looking at this, like this is 100% occupied at the moment. Um, it seems like from what you know the property, it's had a decent operating history as far as occupancy. So it's a kind of a proven historical, or it's a property with a proven historical history. I guess a little redundant there. So you're being more conservative, but you don't want to be too conservative and then no deal looks good because your numbers are not realistic. And so I think we know enough at this point that a tweak like this should cover your bases, and assuming that you're not pushing rents very hard for year one. That feels like the right type of assumption to make in the environment.
right. Okay, got it. And
So
then, okay, anything else to call out on this tab or sheet as far as, because this definitely helps me clear up where I had gaps, where it was like, it's impossible to look at your OM and then your projected stabilized without having with tons of questions. Like, how long is it going to take me to get there? What is my yearly going to look like? What is my profit and loss in transition going to look like? So this is really important, the P&L tab, which I haven't spent much time in at all.
yeah, it's pretty dense, but it really is the source of truth for your property. And so you want to fill in the other tabs to kind of jumpstart you in this tab. But then once you've done the basics, I like to go here and really look at these numbers to get a sense for what this is going to look like as I'm operating it. And if you scroll down to the lines below NOI, you see your cash flow available every year. If you have investors, this is where their return shows up in those columns below there. What your member cash on cash return is going to look like in year one. Because if you have investors that they're looking for immediate cash flow, this type of opportunity may not be for them. But
Right.
if they're fine very quickly getting to stabilize 7 to 10% cash flow, then this might be an opportunity for them. So you start to get a sense for the returns, how quickly it's going to hit those, what your year one DCR looks like. Right here, it's 1.2. If you're using conventional financing, DCR is right there, the very last row. Conventional financing, especially now, is probably going to want to see 1.3 and above. So, but you're using seller financing, so it may not be an issue. But those are the types of things that you start to pick out the more that you do it and the more you see.
Makes sense. So let me ask you this: is this sheet pulling? Is this blank P&L sheet pulling from any of the business model assumptions or like goals as far as years, what year you want to do the refinance and what year you want to do the sale? I see it has it here that it has year 7. So I'm assuming it's pulling from one of these other sheets.
Right. So go to exit strategies, that tab at the bottom.
Mm-hmm.
And at the top there, you got the cash out and you've got your disposition year. So by default, it's a 7-year hold, no refi. But this is where you could come in and put your refi year to 4.
And you would do 4 because that's a full year after you're hoping to be stabilized, or just conservative?
Right. Year 3 is great, but again, being a little more conservative, I just want to see what year 4 looks like.
Mm-hmm.
And what we see, if you see on row 21% of initial investment returned, it's negative 30%.
Right.
Okay. What that tells me is this property is not appreciating. It's cash flowing, but it's not appreciating. So when I go to refi, it doesn't, I'm not going to be able to pull any of my money out.
And
Now,
that's because these,
that's based on an assumption of what the disposition or what the refi cap rate is,
right.
which is in one of these fields somewhere. So, okay, cap rate at refi, line 10, 11.54.
Right.
That's really high.
And where is that being pulled from?
Right. So if you go to the summary tab, look under the key indicators section. It has cap rate at purchase, 10.1%. So that is what you're buying it at, is a 10. If you buy it for the price that you've entered, that's a 10 cap to actuals. So my default is to say, okay, if I'm buying at a 10 cap, I'm going to expand the cap rate as time progresses, a couple bips per year. I think 15 or 20 bips is the default. And if I'm going to refi at year 7 times 20 bips, 10 bips, whatever it is, plus my purchase cap rate equals what I should expect the exit cap rate to be.
Right.
And as we know, expanding a cap rate means lower sale price. So it's a negative indicator. But you may know, hey, I'm getting a great deal on this because it's off market, or because it's in bad condition. And if I were to sell it as a stabilized property that is under good management and performing well in this area, that cap rate, even conservatively, is 9%, 10%. You can adjust it, right? So this is the default. But you have to know what you know of the market and the property to determine what you think a conservative exit cap rate assumption is. And you would enter it there where it says 11.54. You could change it there.
So this 10.1 is pulling from the scenario tab somewhere, I guess, or just this information here, or this information here, I guess, rather.
It's taking the purchase price that you've entered of 820.
Right.
And it's comparing it to the actual NOI of whatever it is in the column 1 there. What's the actual NOI? Of 83. So I think if you do 83 divided by your 820, that's that 10 point whatever percent that's shown in the summary.
Got it. That makes sense. Huh. Okay. I see what you mean. So it's the exit strategies are populating from the summary. And
some of the important disposition numbers are pulled from the summary tab. Yes.
Right. And then this will give you an idea of at exit or at refi if you can recoup your initial investment or not.
Yep. Go back to the P&L tab. Every year at the bottom, it shows you the property value based on a certain cap rate. So if you're looking at an exit cap of 10.5, every year you're going to see, okay, based on how it's performing, this is my actual value. And you see right now, none of those values are above your purchase price that you've entered right now of 820. So
Got
it could be that your exit cap is far too conservative, or it could be that you're overpaying, or it could be that like this is a market that's not going to experience a lot of appreciation, and so you just need to be aware that this is a cash flow property and not an appreciation property.
So let's, if we could just do one more scenario here where, I guess just real quick while we're on, I think these are still a little low. These targets, I just want to see how far off we are. Because I think, let's try 454 and 561, which I think are a little more accurate. As quote unquote currents. And then I just want to see the actuals here. Ryan's favorite place.
I'm going to laugh if someday I retire to Middletown, Ohio. You're like, I was dogging it the whole time, and here I am, happy as a clam, retired in Middletown.
You will end up, all roads pass through Middletown, Ohio. Okay.
Living in your apartment building.
All right. So these are a little bit stronger, but let's still go conservative. So saying a 1-bedroom would be,
Go view the pro report of Rentometer.
okay. Any reason specifically, or is this different numbers?
Details matter. So I like to see the comps that they're pulling up. A lot of times, a 2-mile radius, you might know that in Middletown, it's very pockety, like I know Durham, where I live, that there are certainly pockets, and a half-mile radius is 2 completely different neighborhoods. And I also like to pull up the property details of some of these comps, and I like to see the square footage, just to make sure that, okay, yes, this is a realistic target for me. So look at B, property B. That's half-mile away. It's a $600 rent for 575 square feet.
Mm-hmm.
How big are your units?
I don't know offhand.
Okay. And so, yeah, I would probably pull up that property. I mean, it looks really well maintained just by that one picture, the street view picture. So I would be like, just do a gut check and say, is this a good comp, or is it maybe a better property than mine? And so I need to lower my target. It looks like these are all 1-story style, so you don't have upstairs neighbors. It looks like you have some private area, some lawns. So it might be that this, is a better property. So I don't know enough about yours to know, but that's the kind of thing that I want to look at, is really kind of stress test what Rentometer is telling me.
Gotcha. Makes total sense. It's not, the details matter. Okay.
Yeah, there are several high leverage numbers that you use in underwriting, but certainly average target rents, one of the highest leverage things you can do. So if be really careful when you're just going to throw in another $15, $25 a month because you think you can get it, because like that'll change your numbers. But if you can't get it, it will also destroy your numbers. Same thing with vacancies, things like that are super high leverage numbers.
Got it. Okay. So this needs to be explored further if this was a serious consideration. So definitely worth understanding. So I guess, what did I have here? 600.
So and if you don't want to do that level of detail, I would look at see how they have the 25th to 75th percentile numbers.
Yes.
I usually will go.
Yeah. How do you usually use this?
Between the 25th and 50th percentile. So sometimes I'll aim for just the 50th and be like, that's conservative because I know I want my property to be nice. So I'm hoping it'll actually be the 75th percentile. But for underwriting purposes, I might just take the midpoint there.
Gotcha. Okay. So maybe somewhere like 625 for this.
Mm-hmm.
And then right around maybe 775 for this.
Yeah.
625 and 775. Okay. Got it. Okay. So I'm curious now how much that will change everything that we looked at. And then if there were any other, and then let's say the property could also be acquired for 800,000.
So one of the first edits you made were to the current rents. You actually lowered them,
Uh-huh.
which then is going to lower the actual NOI calculation that you did. And at the same purchase price, that will then raise the cap rate, what your actual purchase cap is, which will then raise your exit cap. So that what you just did, even though you bumped your target rents, you depressed your actual rents, that may make it a worse deal
It might,
because of the
right.
cap calculation, right? So
Right.
again, it's all these kind of interconnected things.
There were a couple of forces from both sides working. Got it. Okay. So after, I guess, just changing a couple of the quick inputs, and then, yeah, quick inputs, we updated the actual rents, the future hopeful rents or target rents. And I don't think anything else was adjusted on this. Let's say maybe we could go to 5.75 and yeah, okay. Anything I guess you would adjust here to maybe sweeten the deal or make it a little bit more competitive an offer from the scenario tab?
Um, you mentioned this is seller financing. What is the down payment situation like? Is he going to want 20%?
Yes, at least.
Okay.
So, yeah. This might actually be 25. It might be worse.
Okay.
Okay. So you would move to which tab next?
Well, yeah, let's go to this. Well, we were diddling around in the exit strategies tab. Go back there and I think reset it so that there's no refi.
You don't think there now? Why do you say that?
Well, I mean, if you look at year four refi, percent of initial investment return 7%, there's still no appreciation on this asset.
Right. Right.
But I think what this does show is that's a really high cap rate, basically 11%. Our assumption here. I would either talk to your broker or whomever your kind of official liaison to that market is, and understand what the going cap rates are for that area. When I purchase a property and it's say it's an 8 cap, well, if I think I'm getting a deal on a property, I don't just assume that I'm just an amazing deal finder and that's why I got a deal. Like, I just assume that that is the market. And so I need to have a really strong thesis of why I think I can do better when I go to sell this property.
Right.
So you at 11%, like, that's a really high cap rate, but it just might be that market. So, if you want to try and see if there's more appreciation here, because that'll certainly change your numbers and might affect your business plan as far as refi, maybe just gut check cap rates in your area.
So you would lower that in the summary tab.
Yes.
If you were to,
If I got confirmation that in fact I am buying this at a great price and it is a deal, and when I could turn around and sell it at a lower cap rate tomorrow, maybe using better marketing or a better broker. If I get confirmation that of a good exit cap, I would put that in there.
so even just, I guess, still keeping it conservative, let's say, I don't know, 10.4, 10.3.
I mean, you're just guessing at this point, but if you want to see what those numbers do, we can certainly enter them.
Well, I have a feeling that I mean, not to guess, it needs to be confirmed. If a broker were to say, 10, you call 3 brokers and they say, go on rate in the area is a 10 cap. Okay.
Yep.
So just playing with that number, seeing what that looks like.
But keep in mind that that's cap rate at resale, which right now we have 7 years from now. So your broker can tell you what cap rates are today, but then you need to apply whatever your factor is for in the future. I'm not going to assume that the market's going to be as good as it is today, or slightly worse or slightly better. So that's where your judgment will come into play, is what it's going to be 7 years from now.
Got it. Okay. Makes sense. Anything worth adjusting on this sheet before I guess doing the final kind of?
Yeah, so this is a deal that you are going to take down yourself with no investors, using your own money. Yep. So I would see where the acquisition fee there on on row 19.
Mm-hmm.
I would take that to 0, because the defaults here for like syndicators, or that you're raising from others. I would then also, down there under investor returns, put member equity to 100%, because you're the sole member of this. And
Mm-hmm.
then, preferred return is 0, because you're getting all the returns. And then I would, 0 asset fees, 0 capital transaction. There you go. So if we look at the final 3 rows there, where they do the average returns,
Mm-hmm.
it's a 12% average annual return. It's about 12%, which are decent numbers. And if you go to the returns tab, it's going to show you exactly where your returns are coming from. So that top table is really where the meat of this is. But you see your return is pretty much all from, we didn't take out that refinance. Go ahead and take out the refinance.
Just do 0 or NA.
Yeah, NA. And you can, if you want to do a sale at year 5, like if you are not interested in just holding onto this as a cash flowing asset for a long time and want to try to turn it as quickly as you can, then you can look at your P&L to see where that value curve starts to taper, right? Because you're going to put effort in to raise the rents. That's how the value is going to increase. And then at a certain point, you're just relying on the market, 3%, 2% annual bumps. So your returns definitely taper out at that point. So if you want to get that money back and go do something bigger with it, you'd probably want to sell once it's starting to level off.
Got it.
So, call it year 5, call it year 4, or you can just leave it at the default of 7.
Mm-hmm. Okay, got it.
Okay. Yep. So go back to the returns tab. And so if we see member cash flow,
Mm-hmm.
it's going to be returning to you by year 2. And once you've started to kind of implement that business plan, it's going to throw off 20 to 40K a year pretty quickly, which is, 8 to 15% cash on cash return, which is a strong cash return. What you see though, you see row 10, net proceeds from sale. That is basically your capital gains from appreciation. Those are pretty small, right? 35K after 7 years of holding it. So what this tells you is that this is just a cash flow play.
Mm-hmm.
That's where your returns come from. It's all cash flow for the most part.
Got it. So looking at this deal, and then I guess back to just the exit strategies, it doesn't seem like there's really a scenario in this deal where you could do a cash out refinance and pull out most of your equity.
Yeah, I mean, so let's look at the best case scenario. You're buying at around a 9 cap, if I remember correctly. Let's say the market, multifamily, continues to be strong. During COVID, it proves that it is in fact recession resistant, so people are even more inclined to put money into this asset class. Interest rates remain really low, so cap rates have compression pressures on it. Let's say in year 7, what you're buying at a 9 cap, now you can sell for an 8 cap. Or maybe at year 4, you can refi at an 8 cap. So go in here, so do a refi at year 4. So you'll be fully stabilized by that point.
Mm-hmm.
And set your cap rate at refinance to 8%. It's row 10.
Gotcha. Set it at 8.
Right.
Mm-hmm.
Okay. And now row 21% of initial investment return you see is 86%. So if every trend in the world is in your favor as far as this asset class and this market, which again we talked about is not super strong market, but you know, maybe something changes. There's a new manufacturing plant that goes in or something like that. You would have a chance to do that, but I certainly wouldn't be counting on that. Everything going right.
Right. So I guess just in this scenario, okay, I gotcha. What made you lower the exit cap as your first lever to pull instead of just lowering the offer price? Or was there any reason you did that instead of the other?
Um, it was more for the exercise to show that even if everything went absolutely right, you're still not getting 100% of your money back, or like it's still, this deal just doesn't have it in it.
Mm-hmm.
If you reset the really optimistic numbers we just did here, so set that cap rate refi back to 10%,
Yeah.
and then let's go in and adjust the purchase price down. I think what you'll see is that you have to bring that purchase price way down to even come close to a refi making sense.
So dropped it to 700
Okay.
and then back to summary. Or no,
Go back to exit. Go back to exit strategy because we're looking at a refi now. So it returns 60%. So it's still, I mean, you're the sole investor, so that may be enough money that you can go and play with and you're fine with it. But usually the rule of thumb is at least 75%. As close as you get to 100% is great, right? Like that's the ideal scenario. So just from what I know that that exit cap is the most high leverage variable to tweak versus the purchase price. But I mean, obviously the purchase price is the thing you can control.
Mm-hmm.
The cap rate is a projection, and reality is gonna slap you in the face if it's much different.
Right. Got it. So yeah, you have to bring it, I mean, way down to even
I
be.
mean, go back to the P&L because the P&L doesn't care what your purchase price is. Look down there at the property value. So add a 10 cap, go through. So year one, it's actually worth 450. Year two, right? So if you compare your purchase price to where it needs to be to equal to get all your money back, counting you have closing costs, you've got transaction fees, right? That starts to really eat away at your returns. You see that you need to get pretty low in your purchase price to meet that threshold compared to the value of the property at the year of refi.
And are you thinking about these rows 54 through 59 as are these like red flags that they're so much lower than your initial list, or is it normal for them to be below your initial list while you're implementing your value add model?
Yeah, when you buy a value add property, a lot of times the cap rates will be artificially low compared to stabilized property because there is opportunity there that you're hoping to take advantage of.
Mm-hmm.
You don't want it to be completely out of whack. So, you might see half a point to a point. If your market cap is an 8 and you buy value add at a 7.5, a 7, that's kind of within range.
Mm-hmm.
Because once you get to your stabilized, you hope that you will have bought at a 10 cap stabilized,
Mm-hmm.
right? But yeah, but sometimes sellers know that there's opportunity there, even though it's not performing well right now. They know there's opportunity, and so the cap rate will be slightly depressed.
Got it.
For value add only.
Okay, this is insanely helpful.
Good. So tell me what you're thinking as far as this as an investment for yourself.
First and foremost, what this is telling me is that I am not ready to be making value add offers until I am better at underwriting. Otherwise, I think I'm in jeopardy of really getting hurt. That's my first and foremost. Like, regardless of this deal, that's like my overarching. Like, I need to analyze like 50 to 100 more deals exactly like this before I feel like safely, if I'm acting as if I'm working with other people's money, but it's my own money, that I'm not being conservative enough making offers without getting more familiar with this sheet. Second thing is that, yeah, this just showed this deal is a lot less attractive than I thought on the outset. And
Because you were hoping for that refi event.
not full, but I was, from another model I looked at, it looked much more likely that you could get close to 75%. I don't want to say easily, but fairly, like fairly easily. Yeah. Which in this case, it seems like it's much more, that would be a reach.
Yeah, I would, we talked about the cap rate being central to your ability to pull money out. I would try to get the last 5 years, what the average cap rate in your area has been, to know what the trend is. The national average, or decent markets have probably seen an average cap rate in the last 5 years go from 7 to 5.5, right? So there's been quite a bit of compression. So if in your market it stayed steady at 9 to 10%, that tells you that I mean, the trends have been nothing but positive for cap rate compression the last 5 years. And if your market hasn't budged, that would tell me that I'm certainly not going to be planning for that cap rate to go any lower than what I purchased at, right? So that'll give you a sense of the trend. And I think that that's important, since that is such a high leverage variable for you.
Yeah, makes total sense. Yeah, so that definitely is eye-opening about this deal. Not to say that
You know,
it's not good about the
there's
model.
something to be said for it's your own money, strong cash flow. It's an educational opportunity for you. That's lowish risk. I mean, how fortunate are we to be calling an $800,000 purchase a low risk thing, right? But for the most part, I think it's low risk. So it depends on what your goals are, right? You can't just say, oh, it doesn't hit 15% IRR, I can't refi out. But if you like, this is all the money, liquid money that you're willing to put into real estate right now, and you want to know that you're going to be able to do something else with it in the future, then yeah, it might be something that makes you walk away from this one.
Yeah. Um, yeah, no, really interesting. Definitely just depends on that exactly. Like if it's a make or break deal, being able to get your equity out, fine. If you're thinking of it from that learning and cash flow standpoint, also fine. Just I think that this getting better with modeling to that, you can have a better like understanding with your expectations so that you're not going to be really disappointed. You could know which matters for what you're trying to do, which is I think the goal of all this, to be as close as your expectation and your forecast, depending on why you're doing it. If you don't know why you're doing it, like for me, without doing this, I wouldn't really know why I'm doing it, and then it would be very difficult to know. So really, really helpful.
Yeah. Good.
Let me stop the recording.